All right, everyone. Good evening. All right, right now it is 5:30 Indian Standard Time and 4 o'clock Dubai Standard Time. I hope everyone is having a great day. Correct. Today being 19th of November, being a Tuesday, we are already done and dusted with the second day of the week. All right, so now we would be talking more about technical analysis. Correct? The markets have been closed. The markets have been done, are done and dusted for today. So our focus from the Indian stock market is shifting to the forex and gold markets. And what is best to talk about the forex and gold markets, but to talk about it from a technical analysis point of view. I hope everyone is present. I hope everyone can listen and see me perfect. So let's get started. I can see Sophia in the chat house. Hello, Sophia. Good evening. Thank you again for being a part of this wonderful community. It is always a pleasure having you in our live streaming session. So let me start today's third live streaming session, right? Let me give you a quick introduction about myself. I am Harsh. I have 8 years of trading experience. I have been trading the forex markets, the commodity markets such as oil, gold, silver, as well as the US indices, right? We have the S&P 500, we have the Dow Jones 30, and we have the Nasdaq 100. We are also looking at the Indian share market, whereby we are analyzing the blue chip indices, correct? Indices such as Sensex and Nifty, as well as analyzing the markets by analyzing the individual Indian stocks as well. I am more of a technical trader. I specialize in technical analysis such as supply demand, price action, order flow analysis, swing analysis, trend analysis, as well as Fibonacci retracement analysis. When it comes to technical analysis, the field of technical analysis is so exhaustive and extensive, but the major content when it comes to analysis is the ones that I have mentioned. I have been blessed and I have been grateful to be mentored by some of the best minds when it comes to the financial markets. I have been taken under the wing of certain people who used to trade or who used to be as floor traders, right? People trading on the floor of the Chicago Mercantile Exchange. So it's been a great privilege for me to be a part of that community in terms of learning and gaining experience, right, from such bright minded people. I have been successful in handling $20 million worth of portfolios and have also been successful in attaining 30 to 35% profitability, right, on an annual basis. The reason I'm showcasing all my credentials firsthand is for you to believe and to be rest assured that yes, the you are being guided, you are being mentored by someone who has experience, who has the knowledge, and who has the expertise to back it up, right, when it comes to financial trading. So let's get started with today's third live trading session. I hope everyone is present and we are going to be having a good time when it comes to technical analysis, correct? But a quick summary in terms of what the markets have done. The Indian stock market, what has happened one just before the market closure, right? For everyone who's attending this particular live streaming session, the Indian stock market is closed. We will just have a quick summary in terms of what the watch list has showcased, how the markets have moved, and then we will jump directly into technical analysis, right? So we had provided to you a hot stock recommendation on RBL Bank. The prices have hit target. We have done well for the day, right? And today's hot stock recommendation, which was provided to you on Marine Electrical, listed on the National Stock Exchange, is currently running, right, in our favor. So these have been certain important summaries in terms of what the markets have done after the stock market is closed, right? Now, let us shift our focus from the stock markets to forex markets to the gold markets and, in particular, technical analysis, right? So, let me open the WPS, our PowerPoint, and today we will be focusing on mid level technical analysis. Please bear in mind, yesterday we had started to talk about the basic technical analysis strategies. Now, today we'll be shifting our focus to mid level technical analysis, right? So, let's start with the first point. We will be looking at moving averages, right? I'm pretty sure everyone is aware of what moving averages are. This is a brief, description about moving averages and what are the different annotations when it comes to moving averages. Some people prefer to use the 50-day moving average, some people prefer to use the 200-day moving average, so on and so forth, right? So the moving average is used in trading as a simple technical analysis tool that helps determine price data by customizing average price, right? So we will be looking in terms of what exactly are moving averages and what are the different types of moving averages, right? So let us understand the first type of moving average, which is called as exponential, right? We will have a good theory session, and after that we will jump directly into the charts and analyze such indicators on a real-time basis, right, in the forex and gold markets. So starting with exponential moving average, as you can see, the EMA is calculated by placing greater weight on the most recent data points, right? It can sometimes be referred to as exponentially weighted moving average. Now, again, the most popular ones are going to be between 12 and 26 for short term averages, and for long term, we have the 50 and 200-day EMAs, right? Um, then this was based on exponential moving average. Now let us look at the other type of moving average, which is called as simple moving average, right? So the SMA is calculated by taking the average closing price of a security over any period desired. So it's basically putting equal weightage to all the values that are being calculated for this particular simple moving average. Now, let us go and see the examples or the annotations of simple moving averages and exponential moving averages. So, let me start with again our most favorite pair, which is going to be the euro dollar. So, first, let me go to the daily time frame and let me put the simple moving average, right? Oh, it did not come. All right, wait 1 second. Let me put the right moving average. So again, I'm going to be plotting the simple moving average and I will be plotting the exponential moving average as well. First, let us start with the simple moving average. So as I was talking to you about, the moving average is nothing but the average price of the last X number of candles, right? And X stands for the length. If I shift the length to a greater parameter such as 50, 100, the more inflexible or the more you know less or the less volatile a particular moving average will be. And if I put a smaller parameter such as 10, the moving average becomes quite volatile, right? It reacts to the most recent price action taking place on the chart. So let me just use the standard moving average that I have been always using, the 20 moving average, right? Now, in terms of its calculation, since we are looking at the 20 moving average, it is going to calculate the data for the moving average based on the last 20 candles, right? So, based on the data, an equal weightage is given to each and every candles of the last 20 candles, right? So, this is the overview or the outlook in terms of how a simple moving average works, right? Now let me put the moving average exponential, correct? Now with the moving average exponential, I just need to make sure in terms of changing the color and the value as well. So let me put purple, and let me make the lines a little more broader, right? So I hope people can see my screen. I hope I am audible and there are no technical glitches, right? All right, so we have the blue color line and we have the purple. Let me change the color to make even a stronger contrast. Let me put maybe orange, right? Because orange will be good in terms of creating a good color contrast. Now people can see my screen. So the orange color line depicts the SMA, the simple moving average, and the purple color line denotes the EMA, the exponential moving averages. Though the parameters are remaining the same, you can see that there is a good amount of difference between the simple moving average and the exponential moving average. Simple moving average takes into consideration the last X number of candles and provides equal weightage to each and every candle that has been calculated, right? But when it comes to exponential moving average, it is only the last candle which is given the most weightage, followed by the second last candle, followed by the third last candle. So there is a succession pattern where the most recent data is given highest weightage and the past data is given less weightage, right? So if you look at the data in terms of exponential moving averages are more conducive to change, right? Because they are reacting based on the most recent data. But if you're looking at the simple moving average, you can see that the simple moving average is slightly less volatile compared to the exponential moving average. Now, when asked about Harsh, that is a good explanation, but should I be using simple moving average or exponential moving average? I will let you decide. You can be the best judge, right? But if you're asking my personal recommendation, I would suggest that you use the exponential moving average, right? So I will do a thing. Let me remove the simple moving average and we will stick to the exponential moving average. The simple structure or the simple understanding that goes in moving averages is if prices are above the moving average, that basically denotes bullish sentiment, right? And if prices are below the moving average, that denotes bearish significance, right? Bullish sentiment, bearish sentiment. Prices above the moving average, bullish sentiment. Prices below the moving average, bearish sentiment. Correct. So this has been a good, understanding when it comes to moving averages. Right. Let us get back to WPS and analyze the next PowerPoints. Right. So we talked about simple, we talked about exponential. Now, how would we be using moving averages? Right now, people have been asking me the second type of question, and that is, Harsh, should we be using moving averages, just one moving average? Should we be using two moving averages? Can we use more moving averages? So, for that particular example or illustration, I would focus on the next topic, and that is the golden cross and the death cross. This is a very important strategy when it comes to utilizing the power of moving averages, right? So let me just go directly in terms of what a death cross and a golden cross is. But for people, if you want to read and have a quick look in terms of what the meaning is, in terms of golden and dead cross, the moving average crossover method is one of the most commonly used trading strategies with the shorter term SMA. Now, remember, you can use the EMA as well, right? It's not necessary that you have to use the SMA. Breaking through the longer term moving average to for a buy or a sell signal. In this particular description, we have been mentioning about the 50-day and the 200-day. You are flexible. It is flexible in terms of choosing. You can even use a 10 and 20, a 20 and 50, a 50 and 100, or as mentioned on the screen, a 50 and 200. You can always be flexible when it comes to utilizing how you want the moving averages to pursue, correct? So in the mentioned paragraph, they have been using the 50 and the 200 day, but we, as in me, Harsh, would be using the 10 and 20, right? So let us get back to the charts. Let me open trading view. So as you can see, we already have the 20-day moving average, right? Input is based on a length of 20 candles, right? So let me put another moving average, and please make sure you're using the same moving average. In terms of, if you are going to use an exponential moving average, make sure that other moving average is exponential as well, right? And if you're using a simple moving average, make sure both the moving averages are simple, right? So I have inputted 20. Now let me input the 10, and let me make it a little broader, and let me change the color. All right, I hope people can see the screen. Perfect. So now what exactly is a golden cross and a dead cross, right? A golden cross is a scenario where the prices have crossed over. Let me showcase it with the help of an arrow, and we call this as golden cross, right? So golden cross is a structure on the price chart based on the moving averages, where the moving averages have intersected and prices are above the intersection, right? Such as the ones that you can see. This is called as a golden cross, where price moving averages have intersected and prices are above, right? The moving averages. That indicates that there is going to be bullish sentiment, right? Now, when it comes to dead cross, it's the opposite of a golden cross, right? So let me just denote it and write it for you. Called as a dead cross, right? So when a structure that takes place where the moving averages intersect and prices are below the moving average, right? So this is called as a dead cross. The moving averages have intersected and prices are below the moving average. Such a phenomenon indicates that there will be bearish sentiment, right? I hope people are able to understand. This is a very strong strategy based on moving averages, which helps in providing more confirmation in terms of whether prices will have a bullish sentiment or a bearish sentiment. Once the moving averages cross over and prices are above, it's called as a golden cross, indicating that the prices will be having a bullish sentiment, right? And similarly for a dead cross, once the moving averages intersect and prices are below the moving average, that indicates bearish pressure, right? Bearish sentiment. So this has been a good understanding when it comes to golden cross and dead cross. There has been another question by one of our viewers, right? And they have been asking, Harsh, what if I want to use more than two moving averages, right? And you can use more than two moving averages. There is a moving average called as a ribbon moving average, right? So we have something called as a moving average ribbon. Now with this particular scenario, as you can see, we have not one, not two, but four moving averages, right? Now, based on the ribbon moving averages, if prices are intersecting and if the moving averages are intersecting and prices are above, it is similar to a golden cross, right? But instead of two moving averages, we have four, right? And similarly, on the contrary, if we have prices which have intersected, right, somewhere around this area, and prices are below, that indicates bearish sentiment, right? So it is very similar to a golden cross and a dead cross, but instead of two moving averages, you have four. But there are certain limitations to this, right? Because the more number of moving averages, the bigger or the longer the time it takes for prices to, shift sentiment. So that is the reason we have been mentioning this, right? Now, let me remove the drawings, but I hope you get a clear point. Yes, you can use one moving average, you can use two moving averages, you can use four, you can use even more than four. But as a general rule of thumb, two moving averages are more than sufficient to provide you with more confirmation, right? In terms of whether the trend is bullish or the trend is bearish. Let us go back to the PowerPoint in terms of. So I hope everyone is clear when it comes to golden cross and dead cross, right? This is a typical example. I have showcased you on real charts, but this is a very good example where price the moving averages have intersected and prices are below. So such a phenomenon is called as dead cross, correct? And on the contrary, when the prices intersect, the moving averages intersect and prices are above, that is called as a golden cross, right? That basically indicates a buy signal, and a dead cross indicates a sell signal. Now we will be looking at mean reversion using Bollinger Bands, right? So typically, how a moving average looks, Bollinger Bands are exactly identical to moving averages, but the only difference is they have a standard deviation where they have two parallel moving averages acting as a range. So let me put the Bollinger Band first for you to see. So Bollinger Bands, right? It was invented by Mr. Bollinger himself, and that is how the terminology Bollinger Bands have come into place, correct? I hope people can see my screen. Perfect. So Bollinger Band is nothing but a moving average having a standard deviation, a range above the moving average and a range below the moving average, right? So if you go into the settings of this particular indicator, you have the length again, which is basically nothing but the moving average. And you can even decide whether you want it to be a simple moving average or an exponential moving average. And you can mention the standard deviation. We have been using a standard deviation of 2, which is quite good enough, right? So mean reversion, right? Using Bollinger Bands. You can forget about mean reversion. Let us just talk about Bollinger Bands, and I will improvise in terms of what are the strategies which can take place, using Bollinger Bands. So the overall functionality of Bollinger Bands is for prices to travel in a particular direction, and the moment there is a correction that is taking place, the prices will have a tendency to return to the moving average. So first, Bollinger Bands can be used to make money on reversal trades, right? Second, the moment prices are within the range of a moving average. The main purpose of having Bollinger Bands is to find out such reversal trades where prices have, reached to the corners of the Bollinger Bands, and then there is a structure whereby the moment a reversal takes place, the prices return to the mean, correct? So this can be used in conjunction with, dead cross, golden cross to get more confluence, right? More probability when it comes to taking trades. Remember, the third live streaming session is based on education, right? And it is very important for you to understand that we do provide you with trading hot stock recommendations when the markets are running. But when the markets are closed, right after the markets close, we shift our focus from the Indian stock market to Forex and gold markets. And the best way to talk about the Forex and gold markets is based on technical analysis. So use this education to get better, right? We provide you with earning opportunities, we provide you with learning opportunities, right? When you combine the two, you get a fireball, and that fireball is you becoming a better trader. Anyways, getting back to Bollinger Bands. So Bollinger Bands are a very good example when it comes to finding the moment prices have approached to the either the upper band or the lower band and have started to reverse. Prices will always come back to the average, all right, to the moving average. Similarly, so we have trades. One second. So we have trades that are, analyzed based when prices have tested the upper band of the Bollinger and has come back to the mean, the moving average. And similarly, onto the contrary side, when prices have tested the Bollinger Bands and they have returned back to the moving average, such a phenomenon, such a strategy is basically referred to as mean reversion, right? Using Bollinger Bands. So this is just the overall depiction of what exactly I have showcased to you on a real market, right? Based on real market conditions. Whenever the markets reach to the outside, to the outer parameters of the band, right? Either the upper band or the lower band, there is tendency for price to return back to the moving average, right? To the mean price. So this is what we are talking in terms of Bollinger Bands, right? And mean reversion. So we have given you better examples compared to the example that you are seeing on your screen. Now let's shift our focus to MACD, right? MACD, moving average, convergence and divergence, right? So let us quickly have a look at what moving average, conversion, divergence is all about. Some people call it as MACD, some people call it as MACD. So there are so many terminologies when it comes to this particular indicator. My bad, right? So let me just put the moving average, convergence, divergence, right? So the overall understanding of what a moving average, convergence, divergence, or what an MACD is basically defined based on two parameters, right? One is the histogram, as you can see, the green color and the red color bars, right? That is called as the histogram. And then we have moving averages, right? Moving averages that are plotted not on price but on the indicator. And that is the whole essence of a moving average, convergence and divergence. The typical analogy, or typical explanation for a moving average, for an MACD is simple. When the histogram is shifts from bullish territory to bearish territory, right? From bullishness to bearishness. How is it? What is the easy way of remembering? Once the color shifts from green to red, right? That indicates that the sentiment is going to be bearish. And if it is in the green phase, right, as the one that you can see on the screen. So let me just quickly mark it with a rectangle so that people should not get confused, right? This is when the green phase of the histogram was active, right? I hope people are able to, make sense out of it. I hope people are not getting confused. I'm trying to keep it as simple as possible, right? So we are just trying to understand how the MACD functions. The MACD comprises of two parameters. One is the histogram and the other are the moving averages. So a general consensus is when the histogram is green in color, there is general bullish sentiment. And when the histogram is red in color, there is general bearish sentiment, right? Now let me delete the lines. Now when it comes to utilizing the moving averages, right? So in terms of utilizing the moving averages, when the histogram is green in color and the moving averages are in that particular territory, right? In terms of whether it is in the bullish phase or the bearish phase, whether it is in the green phase or the red phase, we have to look at the histogram, the color of the histogram, and where the moving averages are at that particular time. So for this particular example, as you can see, the moving averages are above or in the green color, in the green territory of the histogram. The prices will have a general consensus, or will have a general tendency to be bullish, right? Similarly, when the moving averages are below, right, when the moving averages are in the red territory, where the histogram, right, it's come into the negative territory, the histogram, it's come into the negative territory, the histogram is red in color, and that is the time when we see a bearish sentiment, right? So I'm pretty sure we are trying to understand how the MACD works. We don't have to get into what MACD is, the definition and the origin of the indicator. What we are interested is in how we can utilize the indicator to make money, correct? How we can utilize the indicator to improve our learning. So the histogram is the color basically divided into red and green and the moving averages. So if the histogram is green in color and the moving averages are in the positive territory, in the green territory, that is basically having a bullish sentiment for the market. On the contrary, if the histogram is red in color and the moving averages are in the negative territory, in the red territory, there will be bearish sentiment. I hope people are able to understand. This is the basic understanding of an MACD. Now there is something called as MACD and divergence, right? So let me show you. I have given you the explanation in terms of how the MACD is working. Now let's talk about MACD and divergence. All right. Now when it comes to MACD and divergence, the crux lies into this a particular pattern that I would be focusing on. Right. Let me showcase you the example. So what is MACD and divergence? Remember, the full form of MACD is moving average, convergence, and divergence. So do not get confused with moving average, convergence, and divergence, right? We want to keep it simple as MACD and divergence. Now, what exactly is MACD and divergence, right? Let me showcase you with the help of circles. I hope people can see my screen, right? So as you can see, there are two pivots with the prices having a bullish sentiment, right? Prices are going in an upward direction. Let me change the color of my trend line to black. So I'm sure pretty much people can see that prices are in an uptrend, right? With prices creating higher highs, a higher pivot. But if you look at it on the moving average, on the MACD, you will notice that it is creating, you know, an opposing picture on the indicator, right? Where you have prices having, kind of a bearish sentiment. So on the price chart, you have higher highs being created, but on the moving average, you have like, lower highs being created. So basically, a divergence is created. Such a divergence indicates that if prices are creating higher highs and the moving averages are diverging, right, is creating lower highs, that shows that there is a divergence, right? The prices are going in opposite directions, right? Price is going in an upward fashion while the indicator is going in a downward fashion. So what does it result in? It results in something called as a reversal. We would expect prices to continue lower. It is when there is a convergence between prices and the moving average convergence divergence, the MACD, that leads to a higher probability of prices reversing. So based on this structure, when prices were creating higher highs and when the moving MACD was creating lower highs, there was a divergence, and that generally, leads to prices reversing. So that is how you have this onset of bearish sentiment after the MACD and divergence has taken place. All right. So I hope people are able to understand the crux of what a moving average, convergence, divergence, and divergence is all about. Now, let me just make sure to delete all the drawings. I hope people are able to understand. I'm trying to keep it as simple, as as practical as possible, right? So we have covered with the moving average, convergence, and divergence. Now, let us look at some other examples, or let us look at some other indicators which are of importance too, right? Let me go and let me showcase you a particular indicator that I favor a lot, and that is basically called as super trend, right? Now what exactly is super trend? Super trend is a depiction of the trend in simple terms, correct? If the color of the super trend is green, that indicates that there is bullish sentiment, right? And on the contrary, if the super trend is red in color, that indicates bearish, right? That indicates bearish sentiment. So unlike the moving average convergence and divergence, rather than the indicator being plotted separately, the super trend is plotted onto the chart directly, right? So if you're trying to use, this particular indicator in conjunction to price action, and maybe you can use the confluence of moving averages also. Let me put the moving average to showcase what I'm talking about. Remember, if you're getting confluence of at least two indicators, it is a good sign, right? So let me put a moving average exponential. I hope people can see my screen. So let me put the value to 10 or 20, sorry. And let me make the lines more thicker. All right. So how you can use moving average, super trend in conjunction with moving average to make, to give you a higher probability. Let me showcase it. When the prices cross above the moving average, and once the super trend shifts the color from red to green. So you have prices crossing above the moving average, and you have the super trend shifting color from red to green. That indicates that the prices will have a bullish sentiment, right? This is additional information that I'm providing to you, so you should be lucky that you are attending these live streaming sessions, because this is where I'm not just talking about our content, but I'm adding more value by providing you with more content slightly towards the advanced category. So similarly, onto the contrary, onto the opposite side, if the moving averages, if prices cross below the moving average, and the color of the super trend shifts from green to red, that indicates bearish sentiment. It is quite easy to understand, and it is very visual when it comes to understanding how you can use moving averages, and how you can use moving averages in conjunction with super trend, and you get more higher probability in terms of finding and analyzing markets. So I hope people are able to understand. I hope people are getting a clearer picture, right, when it comes to understanding how the markets are moving. We covered about moving averages, we covered about multiple moving averages, we covered about ribbon moving averages, we talked about Bollinger Bands, we talked about MA series, we talked about MACD and divergence, and we also talked about super trend, right? I mean, how wonderful it is, right? With so much of information being provided to you, that is quite commendable, correct? So I'm sure everyone is having a good time learning, right? Because the third live streaming session is based upon learning, right? We want you to make money, we want you to earn when the Indian stock market is open, but we also want you to learn, so you can earn and learn. And when you can earn and learn together, that is the best combination that anyone can ask for. There is one more indicator that I would be wanting to talk about. Let me type it to you, right? So we have something called as relative strength index, right? Now with this particular index, that basically showcases the strength of a particular financial instrument. Now we are talking about Forex. Let us go to gold and look at it, because I don't want to keep talking on the same example, right? Let me talk about gold. So basically, the RSI is an indicator that is having a mirror effect on what the prices are expected to do. So in terms of RSI, I'm pretty sure you are aware that we have two parameters, the 20 or the 30 and the 70. So if prices are coming closer to the boundaries, right, whether the 30 or the 70, that generally indicates that there is a good sentiment for prices to keep continuing or for prices to reverse. As the what you call the RSI is currently, having a bearish sentiment. Prices are also having a bearish sentiment as well. And if the RSI is having a bullish sentiment, the prices also are having a bullish sentiment as well. Generally, people prefer to use it, based on two structures. One is the symmetry structure, which is basically the RSI is a mirror image of price, right? If the RSI is continuing down, there will be a bearish sentiment on the price chart as well. And if RSI is bullish, there will be a pause, a bullish sentiment on the price chart as well. So this has been more towards understanding what RSI and the moving averages, what RSI and what is the functionality of RSI, correct? Remember to talk when it comes to technical analysis, we are trying to keep it structured. We are not just talking about anything and everything. I can keep talking about technical analysis for hours at a stretch, but I do not want to complicate it for our beautiful viewers. So I just want to keep it, structured and to the point, right? So yesterday we were talking about the basics, right? Right from candlesticks to trend lines to channels to double tops, double bottoms, triple tops, triple bottoms, head and shoulders, inverted head and shoulders, continuation patterns, reversal patterns. Today we have shifted to the mid-level technical trading strategies, right? Where we are currently focusing on indicators that can add value, that can add or that can increase the probability for us in taking trades. So again, I would want you to, I would assign you a particular task or a homework, if you want to call it as. Again, I want you to open, let me delete first so that it does not create confusion, and let me write today's homework, or you want to call it as task, right? What do you want me to call it as? You want me to call it as homework because homework sounds kiddish, right? It's like you are back in school and I'm a teacher and I'm making you, I'm giving you homework, and people don't like to do homework. So let me call it as today's task, all right? Task sounds good because if you accomplish a task, you feel happy about yourself. You feel proud about yourself that you have accomplished something, correct? So today's task will be, again, I want you to take on three individual pairs, right? You can take any pairs. You can take even for the stock market if you want to. You can take individual Indian stocks. You can take forex pairs. You can take commodity pairs. The choice is yours. Whether you take Reliance, whether you take Muthoot Finance, whether you take Suzlon, or you take euro dollar, pound dollar, dollar yen, dollar Swiss, or you take gold, silver, copper, platinum, the choice is yours. But I want you to practice on as many financial instruments as possible. If you want to keep it simple, just let's focus on forex. So you can pick up three forex pairs. All right. So take on three forex pairs. The more you can do, the merrier, the better you will become, right? So I'm giving you a reference of three forex pairs, right? Your choice, whichever forex pair you want. Euro dollar, Aussie dollar, Euro odd, GBP yen, GBP GPY. The choice is yours. So take on three forex pairs and make sure to, analyze moving averages, right? Now either you're going to be analyzing moving averages, which would be either a single moving average or multiple moving averages, right? So either you're going to be using a single moving average or a dual moving average, because dual moving averages is where you would be focusing on the two strategies that we had talked upon, right? The golden cross and the dead cross. But you can use multiple moving averages as well, right? The ones that I showcased, the ribbon moving average. So make sure that you look at three forex pairs or three stocks of your choice and analyze moving averages, right? Single, dual, and multiple. Then we are going to be analyzing you're going to be analyzing MACD, right? Let me just type it. So you analyze MACD as well as MACD and divergence, right? How when the pivot points are creating higher highs on the price chart but creating lower highs on the indicator on the MACD, there is a possibility for reversal. So that is what I want you to go and I want you to practice, right? So we have just the moving averages and the second phenomenon called as moving average and divergence, right? So we have moving average and do not get confused between the two, right? They are different. So we have analyze MACD and MACD and divergence. Then also analyze Bollinger Bands, right? Analyze Bollinger Bands in terms of the mean reversion, right? As the prices reach to the corners of the band, whether it is the upper band or the lower band, and the moment price creates a reversal, the prices should return back to the moving average. That is exactly what is meant by mean reversion, right? So you have analyzed moving averages, you have analyzed MACD, you have analyzed Bollinger Bands, you can even analyze RSI, right? So RSI is relative strength index. RSI is a good tool to understand the strength, right? If the RSI is appreciating in value or is increasing in value, there is general tendency for prices to appreciate in value as well, and vice versa. If the RSI is falling down, that indicates there is, a fall in the strength. The term RSI is basically relative strength index. If it is getting stronger, there will be more bullish sentiment. If it is getting weaker, there will be more bearish sentiment. And last but not the least, you can even analyze, super trend. It's your choice. Remember, this is some extra information that I have provided to you, correct? So you can analyze the super trend, and so this is very important, and I would highly recommend. Remember, I'm not your teacher. I am your mentor. I am your guide. I am here to provide you with money making opportunities. So I would, it would be, a sincere request that people can, take the opportunity to practice, take the tasks as a challenge, and test yourself that do you understand what has been discussed today? Do you understand what moving averages are? Do you understand the various forms of moving averages? Do you understand relative strength index? Do you understand Bollinger Bands? Do you understand MACD? Do you understand MACD and divergence? Because I have been talking for the last almost 1 hour, and I want to make sure that the information that I am providing to you is being, beneficial for you. But the only way that a particular information can be beneficial to you is by you practicing it, because the more you practice, the better you will get at it, correct? So I hope people have had a good amount of understanding. I hope no one is sleeping. Yes, remember the third live streaming session takes place after the market is closed. So I'm pretty sure that a lot of you would be, would be tired. The market is closed. People are coming back from their jobs. But remember, if you want to make money, you have to put in the energy. You have to put in the work that is required. So make sure that I've given you a good amount of, homework or task for your betterment so that you can improve your learning. And if you can earn and learn at the same time, that would be fabulous, right? Because you are learning and you're earning. How can you earn? You can earn by being a part of our live streaming sessions, where we provide you with a detailed, structured analysis in terms of which stocks we are planning to enter, which is the entry area, and what is the 5% target. We also keep showcasing our credibility, trading credibility in terms of making potential profits on a real time basis. Today was a very good day where we have been able to close around 12% of profitability as of today, right? With a cumulative profitability of 147% based on 36 trades over a span of 2 months. So, this is the power that we are showcasing. We provide you with money making opportunities in the first two sessions, and once the stock market closes, is where we shift to the to the technical aspects, education pertaining to technical analysis, right? And that is when we start to talk more about forex markets and the gold markets as well. So I hope everyone has had a good amount of learning. We have been talking for such long time, but it is important for people to understand that this is very vital for your success in the field of financial trading. So please make sure to come again for our live streaming sessions. Make sure to attend Harsh's live streaming sessions, because that is when you can make money and learn. You can earn and you can learn at the same time. We will be back tomorrow for again our live streaming sessions. The timings have been shifted. You will get to know more in detail from our team of assistants if you want to know the timings. So I will see you tomorrow. And until then, have a great evening. Have fun with your family, friends, close, love, and near and dear ones. And I will see you tomorrow. So until then, namaste and have a great evening. Take care, and I'll see you.